This is our Forex blog for October 4th, 2012. And like we do most days, the first step of our three-step easy Forex trading system is to identify which currencies are going up the strongest and against most other currencies percentage-wise, and also which currencies are the weakest. So if you use our sortable currency meter, you can see, let me just sort that again real quick. The Swiss, Euro, and CAD are the three strongest right now. The Australian, dollar, and New Zealand are the weakest. We have the real-time trend strength on the top. Underneath that we have the 15-minute trend, hourly, daily, weekly, monthly. And I'm working on a new tool that, you can see this is called the Build Your Own Trend, which allows you to set the weights for multiple different statistical comparison tools that we have. Some of them measure the percentage of currencies going up or down, and some of them measure the intensity, like the range, ADX, the Momentum Pro, 2-minute statistical intensity, 5-minute bar. You can see it's heavily weighted to very fast time frames to let you see the real-time intensities of how much up or down each of these currencies is going against all the rest. I've had some feedback that some people just don't grasp how to use our currency meter, and it's either because I haven't done a good enough job explaining it every day, which may be part of the case, but another thing is some people might not be as visual as I am or other professional traders. And so what I'm working on is combining the real-time build your own trend tool where you can set the time frames, weightings, however you want. And underneath here where you can see the daily, weekly, monthly, I'm going to include those, and you can set the weights for the daily, weekly, monthly in this, and you'll be able to see a lot stronger up moves when the longer time frames are in there. And for the weakness, short amount of weakness right here, if the longer term trend was factored in here, this, instead of looking like a lot of intensity, might look something like this. So you'll just have one indicator to read. And I'm planning on having 60 to 65% of the weight be real-time trend tools, and the other 35 to 40% be the daily, weekly, monthly. I will give more weight to the daily trend, a little bit less weight to the weekly, and significantly less weight to the monthly. The monthly trends basically don't change. If the Swiss all of a sudden went down, it might take it a week and a half of intense down moves for the monthly trend to go from a strong uptrend to a downtrend. So it's very lagging. The weekly one can take 2 or 3 days of intense moves down to switch from an uptrend to a downtrend. The daily one can take 3 to 5 hours of a lot of intensity to switch from an uptrend to a downtrend. You can see, the CAD here had some weakness and then some strength. That strength took it about 40 minutes right here to shift from a daily downtrend to a daily uptrend. So, and you can see the weekly trend still down, the monthly trend's down in that case. So getting back to how to use this, you want to buy the Swiss, you want to buy the Euro against the weakest ones. You can see the dollar had a lot of weakness, real time, daily trend shifted down. In this one, the weekly and the monthly trend are up. With the Australian, however, the weekly, daily, weekly, monthly trend are down, and so when you have some weakness in this come up, especially after a couple hours of strength, and then you can see the strength kind of fell off a cliff right here. There was no strength anymore. You want to use these tools to anticipate. So let's scroll back and look at it at that time. A lot of intensity to the downside, counter trend move up. That strength falls off a cliff right here. The longer time frame trends down. Obviously the Swiss and the Euro are the strongest ones. So look to buy the Euro and the Swiss against the weak Australian. So let's bring that up. The Euro is always on top, so we'll look at the Euro Australian to buy. And I'll just put on the 5-minute chart here. And this is, coming up to around 8:30, right? So looking at the chart here at 8:30, you can see it had a breakout. And what did it do? Well, it went up 10, 20, 30, 35 pips. And if you used, instead of a 5-minute chart, a range chart, let's say 5R, this has to download tick data, and instead of time-based, it calculates based on number of pips moved. And so you can see that breakout there. You also see this nice little 3-bar pullback. I like 3 to 5-bar pullbacks in the direction of the trend. Or you could just simply draw a trend line over those bars. And, you get into that trade, you draw your fibs off that last little tiny move up, and you have your profit targets. And look, you pretty much went to the 1.618 Fibonacci profit target, and that was the end of the move. So you know where to get in, where to get out, It really can't be any more simple than that when you use our currency meter the way it's intended. You want to trade today based on the longer time frame trend. That's, primary it. And I factor in the real-time trend the most. Underneath that, the daily trend's, important. The weekly trend's a little bit less important. The monthly trend's not that important at all. So, when I build a new tool that allows you to have your own weightings, I might only give 5% weighting to the monthly trend and maybe 10% weighting to the weekly and 15% to the daily. So that'd be 15 plus 10, 25, 5% to the monthly. It'd be 30% weight, and give the real-time trend 70% weight. That's probably what I will do with the default, but you'll be able to change it yourself. You can see also earlier in the day, the yen, daily trend's down, the weekly trend's down, the monthly trend's down. We had about an hour of strength, and then it pulled back. And, around 5:30 right here, it's not unreasonable to anticipate the trend going back in the direction of the longer-term trend. So the Swiss and the euro are both strong. At 5:30 right here, look to buy the euro versus the yen. Let's scroll back and look at this at 5:30. And notice, this was trending up. You always want to draw your fibs off of previous moves. This was from yesterday's class. Here's the dead low. Here's the high of that last move up. And notice it pulled back 38%. It also happened to pull back right near the half number, which is a very key support area, and the hourly moving average is there, and the previous day's high. So the currencies, when they break out above the previous day's high, that's a very big sign of strength. Also, this currency, you can see, has gone up considerably from 2 days ago, from 150 up to 101.80. It's up 130 pips, right? So one way of making sure you don't get into a trade too soon is to use a tool that in the past I have not been a big fan of moving averages, but after identifying and figuring out digital signal processing based technology, I really am a huge fan of the very fast 5-period digital signal processing based moving average, shifted 2 bars to the right. And just to give you an idea of what this looks like, let's look at this Dsp moving average. See this on here? Not only is it very smooth, it's also very fast. If I take the Dsp off, look at how much it lags. You can see it shifts over. This is a 5-period moving average. Obviously, when you get up to periods of 20 periods or more, this is 30% faster than that. With only 5 bars, it's not that much, but it is smoother. As you can see, it's very jerky with a regular simple moving average, and this is much smoother. So the farther up a currency goes, the more you're going to need it to pull back. So this was the end of the up move. You can basically wait for a 10-bar pullback. 10 bars underneath the moving average. You got 1 bars, 2 bars, 3 bars, 4 bars. This one closed above it, so it doesn't count. Let's do that again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So at this bar right here, you can start to look for a buy. So let's say you got into that trade right here. Notice this pullback right here had quite a bit of weakness. So it's a little bit less likely to work. And if you get into this trade right here, guess what? You put your stop a pip underneath this low, and guess what? It goes up, and it's kind of going sideways right here. Do you see any signs of strength other than this 1 bar? This is the only bar of strength. It should break out over that high. So basically, I'm moving my stop up underneath these bars low. We're going to lose 3 to 5 pips. That's it. And it's already met the criteria of being 10 bars underneath the moving average. So, and as I frequently say in blog videos and other videos, I like 3 to 5 bar pullbacks. Here you got 1 bar, 2, 3, 4. It's a 4-bar pullback. 1 more bar up. You wait for it to go over that bar's high just to avoid some, unnecessary losses. You put your stop underneath this bar's low, and which also happens to be the Fibonacci area, the previous day's high, and the hourly moving average. And let's scroll over and watch this in real time as if we're simulating the trade. You're in this trade at 101, maybe 55, going up, and still has 51.82 weakness right here. So that's not a good sign for our trade. So we're going to go forward. Now, guess what? A lot of euro pairs are going up, yen pairs are going down right now. That's what our real-time tool is telling us. So at this point, we have a good chance of making a profit. Where is this going to stop at? A lot of times, after a trend's over, it goes back about half. So you got to watch, pretty much eyeball this from 80 to 50, 65 is going to be a key area if it goes above these high. The next resistance area is 73. The next one is this weekly pivot up here in the previous swing high, which was also the previous swing high. So 101.80 is likely to be your maximum profit. Now, if this goes up with a lot of intensity, because it's already hit that level twice, it's likely to shoot through it. So a lot of times if this is the first trade of the day, I'll get out of this trade with a few pip profit here, but because of this, a lot of momentum right here, I'm going to wait and see what happens. And anytime it goes my way and then it comes down against me, I'm moving my stop to break even. All right, so I'm already in this trade have no risk whatsoever at this point. Now, it's been enough time. There's this thing called a time stop, and it should be different for every person. But for me, 15 to 20 minutes, if it doesn't pretty much pop, I will try to get out of the trade with 5-6 pip profit. I'm expecting with the next 2 bars it to go higher, and if it doesn't, I'm going to take a small profit. Now, it went slightly higher. This upticked, as you can see, which is good. So I'm probably going to get out of half my trade here if it goes a pip underneath this bar, just to lock in 4 to 5 pips, and I will see what happens on the second half. All right. Now it's going up, and notice the intensity. It's over 80, extremely strong. 73 might stall. If it does stall at 73, I'll probably exit half. I'm still on the whole trade. All right, so I'm going to get out of probably half my trade here at 70, 71 here, and I'm moving my stop up, because this is a major resistance area. In fact, it does have enough intensity. I'm going to put my stop a few pips lower just to not let the noise get me stopped out. There's nothing more annoying other than taking a loss. The second most annoying thing for me is to have, in this case, what do we have, about 13 pips profit on the first half? To get stopped out with 13 pips profit on the second half and then have it shoot up 30 pips. I hate that. Now notice it's kind of going sideways again here. If the next bar or two doesn't pop up, I'm going to get out of this trade. Because more than likely, if it doesn't go up, it's going to come down. I'm going to, make 2-3 pips less. Okay, so I'm out of this trade around 67 on the second half. And that's how you handle the trade using our real-time tools. Use a currency meter to identify the ones most likely to go up or down, and then, trade them. Now you can see here, the Australian, very weak, a little bit of strength right here. It's very safe to assume with this kind of intensity to the downside that the Australian will go weak again. Right now, we already did that one. Let's try to find another pattern here. The New Zealand also has a very similar pattern. It's not nearly as good as the Australian because the daily, weekly, monthly trend's much more intensely down than it is the New Zealand. But that being said, let's take a look at selling the New Zealand Swiss around 530 because the Swiss is very strong, so is the Euro. We haven't done the Swiss yet. We'll go back to the 5-minute chart, New Zealand, Swiss, 530 is right here. There's 2 main entries that we use for trading. The first one, my preferred one is a pullback. So in other words, you have a trend down, and then you have a pullback trade like this. That's a pullback. This is a pullback. The second type of trade is basically a sideways rectangle pattern, and sometimes the rectangle pattern has a 10 pip range here, and as it's going sideways here, it has even a tighter range. So I'm going to put my stop right above here, have a tighter stop. You get into that trade, it goes your way, then it comes against you. Anytime that happens, you move your stop down, and you can see it, went down a little bit more. You would have had your real-time tools on here. You would have only made a few pips. Shorted here, only made a few pips. The third one, went down, and I would have probably exited half my trade here when it went sideways, and I put my stop above this bar, and typically the fib target is going to be our next profit target. So the first or second fib target, if it shoots through the second fib target, I pretty much have a rule myself. I always exit whatever remaining amount of the position, whether it's 100% of my trade or in this case half of it at the 2.0. Very rarely do markets go below the 2.0 level, so I would just be out. That's how you anticipate using the currency meter, and you want to line up the longer time frame trends. It's really that simple. Now, the reason I'm going into this in more depth than I have in the past is because people are telling me that they're losing money with a currency meter, and I don't quite understand how that's happened. So I've quizzed them. I've asked them to show me their trades, and what they were doing is they were finding a currency that was strong and then has a little bit of a pullback, and then they wait for it to show a lot of strength again. Wait till it to get to plus 80. or in this case, minus 80. So at this point, they're getting into this trade right here at 717 versus, earlier at maybe 530. Well, guess what? As this thing's kind of inching its way down, maybe 15 to 20 pips, you're getting into it at the dead low. And sometimes those trends continue, but probably 2/3 of the time, you've already missed the beginning of the trade. A lot of trades are only 10 to 15 pips. You have to use this as in an anticipatory way and not basically chase a currency. You never want to chase a currency. It's a desperate move. Just like, obviously most women don't react very well to desperate men chasing a currency or being too aggressively following after everyone else has already been in this trade. You're too late to the party. In musical chairs, you're the one still standing. So use this as in an anticipatory thing. It's much better to have a loss here, loss there, 5 pips loss, break even, 3 pip loss, in catch these trades where you're getting it on a pullback. So let's go through the day and try to find one more trade today as we go bar by bar. You want to find a currency like the euro or the Swiss that has 15 to 20 minutes of pullback. Okay, so here we go. A little bit of weakness there in the euro. Not very long. I like each of these bars represents 5 minutes, so I like to kind of find at least 15 to 30 minutes of weakness. So this is really the best you have right here at around 8:30, and you can see the Swiss is stronger than the euro. So let's look for a Swiss yen buy right here at 8:38. We're going to look for a Swiss yen buy. Let's put a 5 pips per bar chart on here because it just looks better, and you can see certain patterns, more often. So 8:38. Okay, so it'll be right around here. So the first trade I'm going to do in this case is going to be a loser. You got a 3-bar pullback, 1 bar up. You wait for it to go 1 bar above the high here, and guess what? This trade's not taking off. So you move your stop up underneath these bars, and you lost 4 or 5 pips. You got another 3-bar pullback, right? So you could buy it again when it goes above that high. And it goes your way, comes down a little bit. I'm very quick to move my stop to break even. As this thing goes sideways for multiple bars, I'm probably going to, in all honesty, get out of the first half of my trade somewhere around 18. I've been in this at 11, maybe 4 or 5 pip profit. Comes back up to the high. It's having trouble breaking through the high, so I'm out. But guess what? Out of half, probably right here. Let's make this twice as thick. The second half, somewhere up here at the highs. I'm always watching and aware of where the high is. So if it goes above the high, the second time can't get above it, I'm going to exit my other trade at 22. So first half at 19, the other half at 22. My average exit is probably 20. In this at 11, I only made 6 or 7 pips, and I lost maybe 5 in the first one. But the point is, even in this absolutely horrible example, with 2 trades, you have slightly more wins than you do losers. And in the other examples we showed before, let's say the Euro Australian, right? This is a strong currency. You've caught, 10, 20, 30 pip profits. You didn't have any losers. Earlier today, the Australian Swiss would have fallen. So, and not only that, but the Australian or the New Zealand Swiss. So in this case, this thing went sideways long enough, you would have shorted it there with your stop above the high. It went your way and then comes back up. More than likely, I would have, just to avoid having a bigger loss, I would have got out right there. Came back to the high and never went above it. So I'm going to go short again right here. And even if I got out of this with 20 pips, guess what? I lost 8 pips, made 20. In making 20 would have been getting out right here, missing the remaining 15, 20 pips down. You have a profit after 2 trades. 1 small loss and 1 profit that's, in this case, probably 3 times bigger than your loss. And that is the key to trading. Focus. Don't worry about whether the trade works or not. Look for high probability trades. Take them. Be honest with yourself. If you're in a trade like this that breaks out and then comes back up, that's not good. And I personally would rather, and I feel more comfortable, the more lots you trade, the more nervous you get. You tend to want to get out of the trade soon. if it's not going my way, I'm going to get out with a small loss here, and not, you have to have your line in the sand. You have to have rules. Usually when a market goes sideways like this, a breakout's going to work. Now, unfortunately, in this case, the first one failed. The second one worked. And the fact that it didn't go above this high is a very positive sign to re-enter. And if you really, don't like to watch it tick by tick, set a wider stop, draw your fibs on there, and you can put your, in this case, have a wider stop. I would put my stop right above the 50% retracement, and I would put my profit target just maybe 3 or 4 or 5 pips above this fib target right here. And the key to trading is small losses, big wins. So if you had taken this short right here, and this was your initial, risk, in this case, the profit is about the same size as the risk. I prefer taking trades that have 1.5 to 2 times bigger profits than risk. If that was the case, then you really want to put your stop a little closer so that you can risk less, and this would meet the criteria pretty much, 1.5 times bigger profit. If you tend to get out of trades too soon, put a wider stop, trade smaller lot sizes, put your profit target out there, and then you can come back later and you're either going to have a small loss or you're going to have a bigger profit. Or, in some cases, you're in a trade either down slightly or up slightly, and then you have to decide, whether to tighten your stop. What I do in that case, let's say I was in this trade, I come back and hasn't hit my profit target yet, I'm going to move my stop to break even, and I might exit half my trade and then, wait and see what happens with the other half. Yeah, that's how you do it. It's not hard. It just, and for some people, you're going to be better off trading and putting your trades on and not watching them. Put your targets, put your stop out there, and walk away and do something else. Work out, watch TV, read, check emails, whatever.